So today's Good Friday, and I didn't know this, but apparently it's one of the busiest golf days of the year. What do golf and mortgages have in common? Par, right? Golf, par, that means a score of 0. When you get quoted a mortgage rate, there is something called the par rate. That means you're not paying anything. You're not paying extra and you're not getting any credits. Let's say, for example, today the par rate is 6%. So if you want to get your mortgage rate down from 6% to 5%, you can pay something called points. And points are percent of the loan amount. So if I'm getting a $500,000 mortgage and I want to go from 6% to 5%, the cost to do so might be 1 point, which means 1% of 500,000 or $5,000. You can also go in the other direction. If you're willing to take your mortgage rate from 6 to 7, you can get credits. Basically, the lender will give you points. They will pay you money in order to send your rate upward. So basically, par rate is 0. If you go down in rate, it costs you money. If you go up in rate, you get money in the form of credits. When does it make sense to pay points? It makes sense to pay points because it might sound like, oh, well, it might always make sense. Like, I always want the lower interest rate, right? Like, I'd much rather pay, 5% than 6%. Well, not necessarily. Let's say it costs you $1,000 to move your rate down 1 point, which is not the actual numbers, but for the sake of argument, this is how we do the math. You take the cost of the buy down, the cost of the point, let's say it costs $1,000. And by taking your rate from 6 to 5, let's say it lowers your monthly payment by $100 a month. So you have $1,000 in cost, $100 a month in savings. So in order to make up for that $1,000 in cost, you would have to save $100 10 times, right? 10 months in a row. So by month 11, you've saved $1,100. By month 12, you've saved $1,200. And basically for the, it's icing on the cake for the rest of the time you're in the loan. So paying $1,000 to save $100 a month makes sense as long as you're in the home for at least 10 months, which is your break-even period. So we do a break-even analysis, right? How much does it cost me and how much savings do I experience in exchange for that cost? And if we experience a savings on a monthly basis, then how many months does it take to break even with the cost? A lot of times when you're buying points to buy your rate down, it's quite a bit of money up front for a pretty small savings in the monthly payment. So a lot of the times the break even will be 7, 8, 9 years out in the future, and that's when it becomes sort of a gray area, because on average, people are in their home for about 10 years. So if it's going to take you 9 years to break even, it's like, are you really going to be in the home for 9 years? So you have to have a good understanding of, or a good estimate of how long you're going to be in the home. So when does it make sense to buy points? Well, when we're doing an analysis on buying points, we do what's called the break-even analysis, right? So if it costs you $1,000 to buy your rate down, and that savings is $100 a month in savings, you would have to experience the $100 a month in savings for at least 10 months to break even for $1,000 cost. And then when you experience the 11th month, now you've experienced $1,100, $1,200, $1,300, and it's just kind of icing on the cake the rest of the way. So in an analysis like that, if you were spending $1,000 and saving $100 a month, you would have to ask yourself, am I going to be in this loan for at least 10 months to break even on this cost? And so that's how we do it. Now, most of the time, when we do the break even analysis, the cost, the savings can be 7, 8 years out in the future. And that's when it becomes kind of a gray area, because it's kind of hard to forecast, am I still going to be in this loan, in this home in the next 7 or 8 years? So we have to take things into consideration, like, is it my first home? And it's probably not, my second one's probably coming up here pretty quickly. Is my family going to be growing in the next handful of years? What's the interest rate environment like? Do I think rates are going to go down and I'm going to be refinancing this thing anyway? So there's a lot that goes into the analysis of whether to buy points or not. So get with your mortgage professional, your real estate professional, and they can help you do the math on when the break even is. And then it's up to you to determine, am I going to be in the home or am I going to be in the loan long enough to experience the break even? So what are the risks of buying points? So the risks of buying points is that you might say, okay, I'm gonna buy these points and the break even is 5 years in the future and I'm definitely gonna be in this home for 5 years, right? If you have a job transfer 4 years in, you've paid X amount of dollars in points, but you didn't experience enough savings. So if you spent $5,000 to buy the rate down, but you've only saved $4,000 in your mortgage savings because you weren't there for the full 5 years, then that might be a case where, you know, you overpaid to buy it down. So that's how points work. So you can receive points, you can pay points, and the interest rate will go up and down. You know, there's a par rate, which is the zero cost rate today. You can go up to get points, you can go down and pay points. You can either experience savings or additional costs on your mortgage. Buying points is a way that you can save money on your mortgage month in, month out, but it's not for everybody, and it doesn't really make sense in every situation. So make sure that you're factoring in your personal timing, your personal costs, and do some math to make sure that buying points makes sense to you. Thanks for watching, and we'll see you in the next one.